Hello and welcome. My name is Evan Knight, President and Founder of Priority Financial Planning. And today we're going to dive into LPL Research's market outlook for 2026. First, in the equity markets, LPL's S&P price target is between 7,300 and 7,400. That would be about 7% higher than where we started the year. This is on the more conservative side of analysts' expectations, with the average gain reported by analysts to Bloomberg sitting around 9%. This chart shows the S&P 500's performance when the index is at or near all-time highs, at the same time that the Fed is cutting interest rates, which is the expectation LPL moves into 2026 with. The green line shows an average return of 18.2% while cutting rates at all-time highs, avoiding a recession. The orange line shows the average return of negative 2.7% while cutting rates with a recession. And the blue line is the average of all rate cutting cycle years, with the market at or near all-time highs. LPL expects the U.S. economy to avoid a recession driven by continued cuts as well as tailwinds from some of the business-friendly dynamics within the One Big Beautiful Bill passed early last year. This supports the case for a positive year for the S&P 500. However, this is also a midterm year. This chart shows the average return, which is the blue bar, the average max drawdown, which is the orange bar, and volatility in the S&P during each year of a president's time in office. Historically, midterms have had the lowest average return, sitting at just 4.6%, with the largest drawdowns at 17.5%, which supports maybe a more muted outlook on equity markets. Flipping to the fixed income side, the market is currently pricing in cuts that would take the Fed funds rate to 3 to 3.25%. If that's correct, the 10-year Treasury is likely in the range today that it will be in at the end of the year. There's a couple really important applications with this that I want to make sure we highlight. First, everyone who's holding out for a significant drop in mortgage rates may be disappointed. This chart shows the correlation between the 30-year mortgage rate with the orange bars and the 10-year Treasury yield with the blue line. What you should notice is that most of the time, the blue line lands very close to where the orange bars do. This highlights a positive correlation between the 10-year Treasury and the 30-year mortgage rate. If the 10-year Treasury does not move much up or down as LPL expects, then it's unlikely mortgage rates will move much as well. The second application is on the investment side. With the 10-year Treasury range bound, there may be greater total return potential on the shorter end of the yield curve. As yields drop, the price of outstanding bonds increases, increasing the total return that bonds can provide for a portfolio. However, there is still attractive income on the longer end, with the expectation that the 10-year Treasury also will not drop significantly. Cash is likely to continue to fall, suggesting better growth potential outside of CDs and money markets, which were popular as interest rates rose. Last, we want to highlight the importance of alternative investments. Alternative investments are simply investments that don't fall into the traditional categories of stocks, bonds, or cash. Typically, alternative investments have a low correlation to stocks and bonds, meaning that if stocks and bonds move down, the alternatives likely stayed where they were or maybe went up. A well-thought-out allocation to alternatives has the potential to provide more consistent returns, though, of course, nothing is guaranteed. One alternative that's gotten a lot of attention here recently is precious metals, more specifically gold. Gold has remained a consistent outperformer across commodities and has even exceeded the S&P 500 return since its bear market low in 2022. Gold has been a major beneficiary as central banks have continued to ramp up purchases with no signs of slowing down. Gold prices have been further supported by safe haven demand stemming from conflicts in the Middle East, trade policy uncertainty, and even the passage of the One Big Beautiful Bill, which renewed some of the U.S. fiscal deficit concerns. There's no telling if gold goes up or down next. However, the role it plays in a portfolio remains. If you want something that moves differently than traditional investments, alternatives are a great place to look. As we look to 2026, it's important to know that though detailed research by many industry experts has been compiled for this outlook, no one has a crystal ball into the future. Regardless of what 2026 brings, I wish you the absolute best of luck.